Welcome to another Options Trading Minute. I'm your host, David, and the information here comes directly from Patrick Ceresna, Chief Derivative Market Strategist for OptionSource.net. In this video, you will learn about how to generate cash flow from your existing portfolio where options are offered on stocks you own. In this case, we'll use exchange-traded funds as an example. First off, we're going to review what an ETF is and what the benefits you have in owning them are. ETFs provide a diversification of mutual funds, but have the liquidity of a stock. You can actively trade them on the Toronto Stock Exchange with no penalties. ETFs contain investments to replicate the performance of market sectors, bonds, commodities, or specific indices. The ETF tracks the net asset value of the underlying investments. So the first strategy we're going to review is the concept of writing covered calls to generate income. Covered call writing consists of selling call options against your existing stocks. To implement the strategy, you must first own shares of the ETF, and then sell one call for every 100 shares you own. In taking that action, you get paid cash up front for giving someone else the right to buy your ETF at a specific price over a specific time. When you combine this strategy of covered call writing with ETFs, you create an effective way to generate consistent cash flow, a way to reduce your cost base of your investments, and a way to ensure your money is always working for you. So let's apply this strategy to the iShares Canadian Large Cap 60 Index Fund, the XIU. In this example, the XIU is trading at $12.50 a share. Through your analysis, you're anticipating the Canadian market to be range-bound for the next 4 months, with an upside range of $13.50. So our objective is to generate some income while we wait for the markets to turn around. So when we look at the 4-month $13.50 covered call, it's bidding 55 cents per share. If we purchase 1,000 shares of the XIU at $12.50, it would cost us $12,500. We then sell 10 calls against the XIU shares and generate $550 cash flow net income. That $550 represents an upfront 4.4% guaranteed cash flow, real money that we made today. We got paid that cash because we are giving someone the right to buy our XIU shares at $13.50 over the next 4 months. So let's look at the different outcomes. We originally purchased 1,000 shares at $12.50 for a total of $12,500. We then sold 10 calls and generated a 55 cent a share or $550 cash flow, creating a new reduced average cost of $11.95 or for a $11,950 net debit. If the XIU was to have rallied above the $13.50 level by the end of the 4 months, your shares would be assigned and you will sell your shares at the $13.50 strike price, or $13,500. That represents a $1,550 profit over your adjusted cost base, representing close to a 13% return in just 4 months. Alternatively, if the XIU is anywhere below the $13.50 price at the end of 4 months, you will continue to own the XIU shares, while getting to keep the 4.4% cash flow. While creating a new adjusted cost base, you are now free to write new covered calls. The second strategy we're going to review is the principle of selling puts to generate income on ETFs. Selling puts is an excellent way to generate cash flow in your portfolio, a solid way to average down the existing ETF positions, an alternative way to buy into the market. So what does it mean to sell a put? When you sell a put, you get paid cash up front for giving someone else the right to sell you the shares at a specific price over a specific time period. You would sell one put for every 100 shares you're willing to own. So let's apply this strategy again to the iShares Canadian Large Cap 60 Index Fund, the XIU. Again, in this example, the XIU is trading at $12.50 a share. Through your analysis, you're anticipating the Canadian market to be range-bound for the next 4 months, with a downside range of $12 or roughly 4% lower than where the market is today. So our objective is to generate some income while we wait for the markets to turn around. So when we look at the 4-month $12 strike price, it's bidding at 87 cents per share. If we sell 10 puts, it would generate $870 cash flow for being obligated to buy 1,000 shares at the $12 price. That represents a 7.25% cash flow return for being obligated to buy the XIU shares at $12 over the next 4 months. If you are assigned the XIU, you will now own the 1,000 shares at an average cost of $11.13 per share. That represents the $12 purchase price minus the 87-cent cash flow. This is a reasonable way to average down your existing positions or using it as an entry strategy for accumulating new ones. Alternatively, if the XIU is trading above the $12 price come the expiration, the put will expire. You will get to keep the profits, and you'll have no further obligation. To summarize, covered call writing and put writing are excellent and conservative strategies to generate consistent cash flow in a portfolio. Covered calls are eligible in RRSPs and 401ks, while put writing is limited to standard margin accounts. Thank you for watching another Options Trading Minute.